Hey everyone, welcome to CoinList Chats on Stablecoins. I'm Andy Bromberg, co-founder of CoinList. We are the platform where the best digital asset companies manage their token sales. Plus, we're launching an exchange, which you can check out at coinlist.co/trade. We are very lucky to have Nic Carter with us today to talk about the growing, changing stablecoin landscape, what's going to happen over the coming year and beyond. Nic, do you want to give a quick introduction of yourself?
Sure, yeah. Well, thanks for having me. Very excited. I've been totally obsessed with stablecoins for the last few weeks now. So I am a partner at Castle Island Ventures, which is a Boston-based venture firm, seed stage venture firm. We invest in startups building on top of public blockchains, at the earliest stage. I'm also the co-founder of Coinmetrics, which is a blockchain analytics company. We're a Series A startup. We basically surveil public blockchains, not for compliance like Chainalysis does, but to determine their economic nature, find out what sort of transactions are occurring on them. So hopefully I can be of use and say some interesting things, in particular on the data side. Thankfully, due to the Coinmetrics thing, I've access to some pretty interesting data on stablecoins. So.
Awesome, thank you. And for the attendees in the room, if you have any issues, just use that chat box in the bottom of the screen. We'll be keeping an eye on that, and we'll respond if there are any issues. Also, there's a Q&A button at the bottom in the middle of your Zoom window. You can click that, ask questions anytime, and we will up and answer during this broadcast. With that, let's get started. Nic, let's start with the big obvious question. What is a stablecoin? What's your taxonomy of stablecoins? How do you think about kind of what this space encompasses? And we can use that as a jumping off point.
Yeah, stablecoin is a really interesting term because I think it's kind of a reaction to the creation of Bitcoin and then subsequently other cryptocurrencies. In that the term itself is a reaction. So, stable coin, that's obviously set as a contrast to unstable coin, which is your kind of native unit cryptocurrency like Bitcoin or Ethereum. That might seem like a very obvious point, but I think if Bitcoin, had never been invented, we wouldn't have called these things stable coins. We would have just called them, digital cash or digital fiat. So, the key thing that I think is inherent to stablecoins is some notion of encumbrances being lifted. Essentially, the freedom to transact without too much restriction. And obviously that's facilitated by the fact that the rails of these digital fiat systems are on public blockchains. So to me, that's the interesting thing about stablecoins. You might contrast that with just straightforward digital currency or currency which exists in a digitized format, which is obviously what we have in our bank accounts. To me, that's kind of encumbered, that's held within the purview of the financial system, mostly controlled by the US. So you might compare stablecoins to something like euro dollars, which are dollar deposits in offshore bank accounts, which are not controlled by the Fed and are really outside the purview of the US central bank. And so they are considered to be less encumbered. So sometimes people call stablecoins crypto euro dollars, which I think is actually quite appropriate. In terms of taxonomy, I think they differ along what the collateral is. So what's the nature of the collateral? And obviously there are implementation differences, but I think really evaluating it through the lens of collateral is the best way. So you have over collateralized stablecoins like DAI, which have kind of crypto native collateral, for the most part Ethereum, which is no one's liability. So that's very important. That means you don't really need a central administrator to manage everything. It means potentially it's kind of more resistant to censorship and less encumbered. And then you have straightforward, general sovereign currency being used as collateral. So that would be Tether, USDC, Paxos, TrueUSD, etc. And so generally those are backed on a one-to-one, or in some cases less than one-to-one basis by dollars in bank accounts somewhere. That implies that there's kind of a central point of failure potentially, that there's a bank, which can be scrutinized, and probably has some compliance duties, or at least the administrators have compliance duties. And then of course you have the third category, which is the kind of senior and shares model, which is what Basis was trying to be, which is what CELO is. I believe Terra is that as well, whereby the system kind of collateralizes itself. So there might be some reserve, and it algorithmically tries to hold a peg in the same way that certain central banks might try and hold a peg against a foreign currency. So that to me is maybe an extremely challenging and potentially impossible task, given the fact that some central banks have failed to do that, even with billions of dollars on their balance sheet. But maybe the most actually interesting form of stablecoin, because you have a notion of capital efficiency, and that you don't strictly have to over collateralize potentially, and you also potentially have a notion of censor resistant. So I think those are the two axes along which stablecoins vary. One axis being capital efficiency, and the other one being permissionlessness. So what are the encumbrances that transactors have, if any?
Yeah, that's really interesting. So right now, of that taxonomy, the fiat collateralized, or at least allegedly fiat collateralized category is far and away the biggest by market cap and by volume traded, namely because of Tether. What do you think is going to happen maybe over the coming year or beyond? Do you think that a different category is going to break out? Do you think that is the category that's on track to maintain dominance? What are you thinking about in terms of how that'll play out?
Well, what's interesting is about 10 minutes before we went live here, Steve Mnuchin, the Treasury Secretary, said FinCEN has some guidance on cryptocurrencies, crypto assets. If I had to guess, I think that may relate to stablecoins. So it could be that life is about to get a lot harder for some of those issuers of stablecoins. That's me idly speculating, but I just wanted to make note of that. Yeah, I think it's very unsurprising that the fiat-backed stablecoins are the most popular by market cap, because they're the cheapest to create. If I have $1, I can create $1's worth of USDC, but it costs me $1.50 at a minimum to create a DAI. And if we're talking about finance, we're talking about capital efficiency. That is king. That is what determines what lives and dies. The same thing, with startups, for instance, right? That's why venture investors invest in software businesses, and they don't like hardware businesses as much, right? So I think there's also a notion of kind of path dependence that matters. So the fact that Tether has this 5-year history, and this ability to resist shocks, even though it's had so many obviously hiccups over the years, that also that gives it some credibility, in the market's eyes, in the eyes of traders that use it. So, I think the stablecoins with the longest track records are likely to, continue their dominance. All of this assumes that there isn't some sort of dramatic regulatory action where the issuers of these fiat-backed stablecoins face some sort of catastrophic compliance burden, which is entirely possible, actually, and very much to be determined on that front. I mean, Tether right now is embroiled in kind of a long-running court case with the New York Attorney General. Some of the other stablecoins are more salubrious. USDC, Paxos is highly regulated in New York, but regulators still may have really difficult questions of them when they realize that maybe the blacklist model is perhaps not the model that they like very much.
Well, let's talk about that, because I think there's this perception that the stable coins are freely issued. We're guessing that there be objections the regulators have to, even to these more legitimate fiat-backed stablecoins. What do you think those objections might be? How do you think they're playing into the regulatory landscape right now?
So it's interesting because, to me, I don't know what's happening in those conversations between these fiat-backed stablecoins and their regulators. However, it appears to me that they are claiming that simply authenticating and performing their KYC AML duties at the redemption and the creation layer is sufficient. So it seems to me that's what they're representing to the regulators. So you have to make yourself known to Center, to essentially either Coinbase or Circle, in order to create some USDC. So that maybe satisfies that KYC requirement. But then what's interesting is, once those USDCs exist and they trade on exchanges or they make their way into DeFi, they're circulating on third-party wallets because they're an ERC20 with virtually no restriction. There is a blacklist function built in to the Center protocol, as is the case with every other fiat-backed stablecoin. Tether actually blacklisted $30 million worth of Tether a while back after there was a hack. So these blacklists do get used, but on a very occasional basis. It's not a frequent thing. So they're not performing this kind of advanced compliance at the transactional level the same way that PayPal or Venmo would be. If you put, Cuban sandwich in the memo field of your Venmo transaction, there's a risk your account gets frozen. That doesn't really happen with any of these stablecoins that exist as ERC20 tokens. The freezings are very, very uncommon. So the transactions themselves are not really being actively surveilled, or it doesn't appear that they are. Now, of course, you can use Chainalysis to look at the transactional graph and maybe try and pinpoint if something, insalubrious is happening, but that's like not a precise art. I can tell you firsthand, as someone who has a business that performs chain analysis, that is not a precise art, and you can't have that same knowledge about what transactions are being used for. So if these stablecoin issuers are representing to authorities that they can have perfect knowledge about the interior of the transactional graph, and the authorities are buying that, I actually don't think that's entirely a true claim. So I'm kind of surprised that we've seen them grow so large in such a short period of time without regulators, raising eyebrows about this. So my guess is that there will be some sort of critical moment at some time, maybe in the near future, where this issue kind of comes to light.
Yeah, I want to put a fine point on the blacklist, and the comparison is that for most products that allow you to pay right now, financial products or technology products, it's a whitelist model. So users have to be, approved for KYC, or they have to link a bank account, or they have to do something to prove their identity before they can do anything on those platforms. And what's happened here is that they've kind of snuck by in some way and said, well, we're, at the time of redemption or issuance, at the on-ramps and off-ramps, these users have to be verified. But other than that, this money can flow freely. And that's with the exception of being blacklisted, which to your point hasn't happened that much, but may also be really challenging to figure out who should be blacklisted in these systems. So I guess maybe going back to the history a little bit, we've been talking about forward-looking things, but like you were saying earlier, these digital cash models have been tried previously. What happened with those? Did they have these regulatory issues, or how were they structured to avoid?
Yeah, sorry, you froze up for a little bit there.
I was saying with the older digital cash type assets, the projects that have happened in the past 20, 30 years, how did they deal with this regulatory issue? Did they have issues with it? Was there a way they found around it? What was the solution there? What was the outcome?
Yeah, and I guess some people might take issue with us comparing the stablecoins that exist today on public blockchains to prior digital cash projects, which were fiat denominated. But I see them as basically the same breed of thing, with differences on the implementation side. Because really the objective has been the same all along: create stable value indexed to fiat currency or CPI or gold, and render it natively transactable through a communications medium, in our case the internet, and allow for final settlement to occur between mutually untrusting counterparties. Now you might say, well, aren't like credit card transactions online that exact same thing? Well, they're not, because there's no final settlement, right? So that's the interesting thing, is that you have finality for a fiat denominated transaction. And that's actually a very important and powerful thing if you can get it to work. So long before credit cards and the sort of e-commerce rails became popular on the internet, entrepreneurs were trying to solve this problem of transactional finality online. David Chaum with DigiCash was probably the first entrepreneur to take a serious stab at this. He actually got started in the 80s, long before the consumer internet was really a thing. And that was actually a software client which you would install on your PC, and you would have to partner up with a bank, and create these e-cash coins, which were dollar denominated, and you could send them to anybody that had the DigiCash client, basically. So that's always been an objective, and DigiCash failed because the company behind DigiCash failed. So their issuer basically went bankrupt. But you had other attempts at this same thing. So eGold is another really popular example. And if you've looked at the early history of Bitcoin, a lot of the cypherpunks discuss the failure of eGold. So eGold basically was a system where you didn't really have KYC whatsoever. So there were no real encumbrances. So in that sense, it actually resembles some of the stable coins of today. And you would wire in money, you would get it was indexed to gold. So you would get the unit of account was a gram of gold, but it was all virtual. And you could send it to anybody with an eGold account, which just required an email address. And you could put whatever email you wanted. So that was a truly unencumbered system. eGold collapsed when actually the scope of FinCEN expanded dramatically in the wake of 9/11. The Patriot Act came to stipulate that FinCEN had jurisdiction over a much broader range of money transmission services, and they redefined that to mean any movement of value over the internet, which included eGold, even if eGold wasn't strictly considered dollars because it was kind of gold denominated. And so the entrepreneur behind eGold, Douglas Jackson, he was found criminally liable for not registering as an MSB, basically, and for failing to get those state-by-state licenses, which exchanges will know very well. And so he didn't go to jail, but he had to wear an ankle bracelet for 6 months, and that company collapsed. And the last one is Liberty Reserve. So Liberty Reserve tried to do basically the same thing, create finality for fiat-denominated payments. The denomination was in dollars, and that one ended in tears and ended really badly in 2013. And the founders of Liberty Reserve, I believe, got 20 years in jail for violating kind of money laundering statutes. So, all those early experiments, they basically died. In the case of DigiCash, because they just couldn't get traction. And then in the case of Liberty Reserve and eGold, because regulators came down on them hard because they couldn't build a sufficiently robust compliance program.
Yeah, really interesting history. One thing you brought up a few times there is finality. So cash, physical paper cash, also has finality. Right? If I hand you $10, it is no longer my $10, it is your $10. But cash, to the point we were making earlier, also doesn't have monitoring on the individual transactions once the dollar is issued. If I pay it to you, the government doesn't know that analogy plays into or doesn't play to this fiat-backed stablecoin.
Sorry, lost you for the last 10 seconds there.
It keeps breaking up. We're working on it. The question is just how cash and its kind of final nature plays into the stablecoin analogy, because it seems like they function in kind of similar ways where on-ramps and off-ramps are regulated, but transactions directly peer-to-peer are not surveilled.
Yeah, and you might say, well, if we're creating digital cash, then why should anyone be subject to these more advanced surveillance requirements? And I have a lot of sympathy for that view. I mean, I think the existence of cash, with its resistance to surveillance and its final nature and its private nature, is incredibly important for a society that's free. And there are many societies, authoritarian states, that don't value this at all, and basically insists that the full transactional graph for every individual that data be exported essentially to the government or to large tech companies. Now, in the US, we don't strictly believe this, but ever since the Bank Secrecy Act, the surveillance requirements have been creeping up and up. And one interesting way people don't realize this is actually through inflation. So the limit where you have to disclose the origins of a certain amount of cash is $10,000 if you deposit it in a bank. And if you do lots of smaller deposits, that's a crime called structuring. So $10,000 is your threshold. This limit was set a long time ago. Every year, the dollar depreciates. And so that $10,000 represents less and less purchasing power. So thanks to inflation, we now have more and more surveillance. The threshold at which your cash deposits are surveilled keeps getting lower and lower in real terms. So surveillance in the US has been creeping up, and unfortunately, it's becoming maybe kind of an afterthought, or governments in the Western world are increasingly becoming hostile to any private systems. So even cash is kind of under assault. And there are ways actually to surveil cash, but they're quite difficult. So in some countries, the ATMs will take note of the serial codes on cash as they dispense it, and they might pair that to your account or some facial recognition. So there are ways to surveil it, it's just more challenging. But the question is, can we have a cash standard in a digital age? I'm optimistic and hopeful that we can lobby the government to restore some measure of digital privacy so that we're not subject to these extremely onerous like surveillance requirements, so we can have finality for transactions in a digital context, because that's where we all live. We live digitally. We can have finality and privacy. So kind of in I guess in a perverse way, this bargain that stablecoin issuers, fiat-backed stablecoin issuers, have struck with regulators is quite a good one for privacy. My question is whether it's tenable, whether it's sustainable.
Yeah, that's really interesting. You were talking about other governments there, and we were talking before this webinar got started about kind of this crypto dollarization trend, which sounds like you think is a compelling one for 2020. Can you talk about what that means and what impact you think it'll have, and also perhaps how it'll affect the stablecoin market?
Sure. So there's this concept of dollarization, which occurs when a foreign government, a foreign central bank, or individuals in a foreign country accept the dollar. So in the former case, it's a top-down thing where the central bank declares the dollar to be legal tender, or the citizens of that country spontaneously adopt the dollar in response to hyperinflation. And this has happened in many cases in places like El Salvador, Cambodia, Ecuador, Argentina at times, lots of island nations, British Virgin Islands. So dollarization, Zimbabwe, of course. So it's happened on a hodgepodge basis, mostly in countries with kind of failing or irresponsible central banks, where the government realizes, okay, let's just outsource our monetary policy to the US. But it's also failed. Dollarization has failed in some of these countries because typically because the government has raided the commercial banking system. So in Zimbabwe, if you had dollar deposits after dollarization in your local commercial bank, the government actually confiscated that, and they swapped out those dollars and they exchanged them with something called Z bonds or something or other, which did not have the same convertibility promise as actual dollars. And then dollars themselves became very scarce in Zimbabwe, so they weren't widely available. So the dollarization kind of failed, and they ended up having a mixture of about 4 currencies that were circulated. So then, the question is there a way to have dollarization occur with kind of less friction, basically? And is there a way to distribute dollars on a direct-to-consumer basis? And of course, that's the promise of the infrastructure that the crypto industry has built, right? So we now have local exchanges distributing Bitcoin, Ethereum, and other cryptocurrencies in virtually every country on earth, we have wallets which work on your phone just with biometrics. You don't even have to write a seed down. So that's a really big advancement. That means that you can hold digital value local to yourself. You're not beholden to anyone else. You don't have to put it in a bank account. You can truly own it, assuming that the convertibility promise holds up at whatever bank it is that guarantees the stablecoin. But so thanks to public key cryptography, the infrastructure building on top of that, and exchanges, now we have the potential for dollarization to occur spontaneously in a less frictional way, and in a way that the local government actually can't really interfere with. As long as these individuals have internet, they can dollarize now. That to me is dramatically different than even what we saw as recently as 2008 in Zimbabwe, where dollarization basically failed because the government was able to confiscate this stuff. So the anti-confiscation nature of crypto means that maybe dollarization will be more effective. And generally speaking, I would say I'm in favor of dollarization because there's strong welfare gains for individuals who might be living under hyperinflation. They would just want to find a way to safeguard their assets, basically. So I'm pretty optimistic about this trend. The one risk, of course, or the biggest risk by far, is that the big issuers of stablecoins like Tether, the Center Protocol, TrueUSD, et cetera, that they face significant regulatory headwinds, and maybe the issuers have to close up shop. I think that would be catastrophic, because right now the non fiat collateralized stablecoins are not big enough to service that demand.
Yeah, that speaks to actually a question that one of the viewers asked us, who preferred to remain anonymous. What is the most decentralized way, in your opinion, of having a fiat on-ramp? So are there ways that are compelling where people could onboard into crypto, maybe in a country that isn't level, or a country that isn't dollarizing at the state level, but the people are interested in dollarizing themselves?
Yeah, I would say the most kind of censor-resistant or decentralized way would be to use a peer-to-peer marketplace. So a good example would be local Bitcoins. Local Bitcoins is just a service that matches up people that want to buy and sell fiat for cryptocurrencies. And they do have a kind of an escrow service, so they can resolve any disputes if they arise. But so that's exactly what local Bitcoins is for. That's why people like to look at local Bitcoins data as a proxy for what the local enthusiasm is, especially in the developing world where you don't have Coinbase in these countries. Other examples would be BISC, BISQ. It doesn't have very high volumes, but that's because people always prefer convenience over something that's decentralized. HODL is another example that just works for Bitcoin. Basically uses a 2 of 2 multisig on-chain to ensure that the buyer and the seller agree on the nature of the transaction. And so these systems are all built for fiat on-ramps into crypto in a highly censor-resistant way. Basically, if you have an internet connection, you can use them.
That's interesting. Where do you fall on Bitcoin's ability to eventually function as an effective stablecoin, which would really be kind of the most decentralized and censorship-resistant version, should its value be able to kind of even out and stabilize? Is that a compelling possibility, or are you discounting that and focusing more on non-Bitcoin crypto assets?
In the near term, I think there's no chance whatsoever that Bitcoin's volatility is ever sufficiently low. And if you look at the usage characteristics of stablecoins relative to native crypto assets like Ethereum and Bitcoin, stablecoins have way higher velocity. So they objectively get used on a transactional basis far more than your native crypto assets like Bitcoin and Ethereum. So it seems to me that the volatility is prohibitive for some class of economic activity. That's not surprising. That's the main objection that monetary economists have to Bitcoin. It's a good objection. That doesn't mean that I don't like Bitcoin. It's just not that suited for a specific class of transactional activity. And then the question is, will its volatility ever temper off and decline? I think it will, but we also have highly volatile asset classes that are still in the trillions of dollars. So oil is pretty volatile. Even gold is fairly volatile when you look at it against the dollar, for instance. So it's quite difficult, to just hope that Bitcoin's volatility will ever decline enough. I mean, I could imagine a maker style system built on top of Bitcoin. I'm sure that'll be possible technically at some point. And then you would have high quality collateral, and you would have a more sensor resistant stablecoin as opposed to a fiat backed stablecoin. So the equivalent of maker, but just with Bitcoin as the collateral. I think that'd be interesting, but then you would still have the capital efficiency difficulty. So it seems like for now, we're still going to need to figure out a way to inject fiat into these systems, because there's a certain class of user that just prefers it to cryptocurrency per se.
Yeah, absolutely. Yeah, I have heard a bunch of discussion recently about the potential for a Bitcoin zone on Cosmos with a maker-like system to develop a stablecoin there, which also seems compelling.
Yeah, I think it's a wait and see kind of thing, and you also have to keep guys trying to build that the Bitcoin bridge in kind of a trustless way. It seems like in many cases those bridges do introduce some costs in terms of capital and efficiency, so TBD on that front. But yeah, I think eventually we'll basically figure out how to create a maker style stablecoin on top of Bitcoin.
Maybe on the exact opposite end of that spectrum, you've got Bitcoin as a potential stablecoin. We got a few questions here from folks about central bank digital currencies. Are central bank digital currencies compelling to you? Do you think they're interesting? Are they interesting but just kind of unrelated to the conversation at hand about stablecoins? Where do you think they fit into the mix?
Yeah, it's an interesting question. It comes down to like difficulties over like nomenclature. So you might say, well, to the extent that a stablecoin is a digital representation of a fiat currency, then it's the exact same thing as the currency in your bank account. Or if you have an account directly with a central bank, as is the case with a CBDC. But as I said at the beginning, I think the difference is in the encumbrances, the transactional freedom that you have. So one good example would be Ecuador. Ecuador created a CBDC. Remember that Ecuador is a dollarized country. So the dollar got adopted by normal folks, and that catalyzed, that forced the government's hand to dollarize. So in 2014, the government created a CBDC where you could have access to essentially a tether style product where your IOU was a claim on some dollars they held in reserve. And this didn't actually get much adoption because basically no one trusted the government. And in fact, they trusted banks more than they trusted the government because with the government, they felt there was default risk. So, I think the issue there is that with a CBDC, you're still kind of exposed to what the government is trying to do. With the stablecoin, even a fiat collateralized stablecoin, it looks more like a private banking system where the issuer is a private institution as opposed to a government. And the question is, what will be your transactional freedom in the case of a CBDC, and will you be able to retain some transactional privacy? I think the main reason that central banks are so interested in stablecoins is because they want to surveil the whole transactional graph. They want to use it as a vector of control, and they want to be able to do things like impose deep negative interest rates on society to achieve their kind of monetary objectives. And to the extent that cryptocurrency is a rebellion against all of these things, I think there's a really important distinction between kind of the crop of stablecoins that we have and what CBDCs of the future will look like. But it is an interesting question because I think maybe we should adopt different nomenclature that kind of takes notice of this important thing. So, I would agitate to call stablecoin something like unencumbered digital cash, or interoperable digital cash, something like that. I'll think of a catchier term.
Yeah, we'll work on that. it does. We were talking earlier about the types of collateral. So you can have fiat collateralized, you can have ETH collateralized like Maker, you can have a Bitcoin collateralized asset. That feels like one economic characteristic of a stable coin. The other is what it is stable with respect to. So mostly we've been talking about kind of dollar stable coins, so things that are pegged to a dollar. But there's also been discussion about maybe CPI pegged stable coins, so things that are pegged to some purchasing power index, or even other gold-backed stable coins. Someone asked a question about this in the chat. Paxos's gold coins. There's all sorts of different things to peg will gain share. Do you have any thoughts on what will gain market share and what is most compelling of the peg to dollar, peg to gold, peg to purchasing power, peg to something else categories?
Yeah, it's a great question. I think I remember the basis folks saying that they would eventually peg to CPI. Because it's always a good response to the objection, well, the dollar depreciates at 2% a year and other sovereign currencies depreciate more. And if you look at the relative success of stablecoins, the dollar is by far the largest. You have some euro-denominated stablecoins. I think you have some renminbi denominated stablecoins out there and some gold-denominated ones, but the dollar is by far the most popular one. I think this is because using the dollar as a unit of account eliminates a lot of mental frictions, because you don't want to have to be doing these Forex transactions in your head all the time. So if you did peg it to CPI, and this is a critique of Facebook's Libra, which would be pegged to a basket of sovereign currencies, kind of like an IMF SDR. If you did that, then you're introducing a brand new unit of account. So users have to constantly be aware of that. And the currency that they denominate their lives in may not end up being the currency that they have to spend with. So that is kind of just a mental cost, I think. So you're going to have to weigh the advantages of having a peg to something which depreciates more slowly than the dollar against the cost of imposing those mental transaction costs on users, which is why I think ultimately that people will actually just prefer dollar-backed stable coins, even if they do depreciate if they have inflation.
That's interesting. We got another question, just going back to the central bank angle for a sec, from Michal Benedinsky, saying, what's your view on fiat on enterprise fiat-backed tokens built for use within the walled gardens of financial institutions? So kind of digital assets used to move money around within a single institution. Is that a short-lived experiment, limited use, especially given central bank digital currencies coming, or is there a world where there are many stable coins with many different use cases?
That's an interesting question. I think that that might be a reference to JP Morgan coin, maybe. I know lots of those big financial institutions have announced their desire or intention to create a stable coin. I spent some time at Fidelity as part of their crypto group. They never explored the concept, actually. They're much more focused on custody. I am not certain what those are going to look like. They may just be trying to achieve some sort of back office efficiency that may well be useful to them. But if it just circulates within a walled garden, to me, that kind of defeats the purpose of having a stable coin. I think the reason stablecoins are interesting is because you can transact with them on a variety of third-party wallets. You don't have to ask permission. Again, you're kind of less encumbered than traditional financial systems. That's the thing that's interesting about them. So to the extent they're just stuck behind walled gardens, I don't see why that would necessarily be particularly interesting or have a chance at displacing the dominant stablecoins that exist today.
Yeah, that makes a lot of sense. We have just a few minutes left. One last kind of direction of questioning here: value accrual. Stablecoins are being built by all sorts of private issuers or by kind of decentralized projects. In the traditional world with cash, people have interest money to a financial institution. The U.S. government gets benefits from issuing money when they want to. How do you think about where the value will accrue? We've seen some stablecoins launch. Basis, for example, had a mechanism where as basis grew, value would accrue to a certain class of token holders. Or where do you think value will end up accruing in the stack for these stablecoins as they grow?
Yeah, that's something that we've been pondering over here at Castle Island. Obviously, we've identified this as a potential mega trend, something we're quite excited about. We think is going to dramatically change the nature of this industry over the next couple of years. And given that we're a venture firm, that's what we're professionally curious about. If any of the seigniorage share stablecoins actually work in the long term, the rewards to the folks that own the claims on the seigniorage. So in the case of Basis, it would be the base shares. I think CeeLo has a CeeLo Gold concept. Terra has this token called Luna. So to the extent that those work, the rewards are going to be ludicrously large for whoever has a claim on that spigot of seigniorage. Because if your coin ends up, actually seizing market share, right now the market size is $6 billion for all the public stable coins. In a year or two, it could easily be $100 billion. There's trillions of dollars of so-called euro dollars, which circulate outside the purview of the US. So there's an enormous demand for unencumbered, dollar-denominated deposits, which circulate in a kind of a free manner. And the first product market fit was for traders moving their money around on exchanges, but we're actually seeing people use them in commerce now, and to a significant degree. So if you own a share on the seigniorage shares style stable coins and they work, the rewards will be enormous. Now the question is, I don't know if they're going to work, right? So we'll see. The issuers themselves of the fiat-backed stable coins, the rewards are less because they have to keep 100% reserve, or in theory, they're meant to keep 100% reserve. In practice, Tether didn't, but the other ones do. And so then, how do you make money on that? Well, you store the user deposits in a bank, and then the bank itself lends out the value there. So they'll lend it out at the risk-free rate in short-dated securities, 3-month treasuries. And so you might be collecting, I don't know what the rate is today, but like 1.5% annualized. So you're making the net interest on the float essentially. And that's actually not that profitable because interest rates are super low right now. And if interest rates eventually end up being negative, in the US they're negative in real terms right now relative to inflation, you're not going to make a lot of money being a fully collateralized stablecoin issuer. Then the question is, well, is it going to become normalized to be a stablecoin issuer with partial collateralization? So like we had in the free banking era, in the pre-Civil War era in the US, or in Scotland from the 1800s, will we have a return to free banking where these banks are issuing IOUs with various levels of collateralization methods? I think that's entirely plausible. I think that could happen. And I think that would be really interesting. At that point, you are engaging in more standard maturity transformation behavior like a bank, and then you can make a lot more money because you're engaging in banking, essentially. So that would be one class of winners. And then the last class would be anyone that's facilitating the exchange between fiat currencies, cryptocurrencies, and stablecoins. So that would be wallets, especially wallets which are targeting individuals in the third world who maybe only own a smartphone. So any of those new biometric wallets, which don't require you to write down your seed. And of course, exchanges and kind of local money changers, those would be the big winners. And if we do see a crypto dollarization event occur, there's going to be dozens and dozens of kind of local money changers, like you have on many street corners in places like Iran. You have amateur money changers essentially. So businesses servicing that any of those businesses which aim to allow direct-to-consumer distribution of crypto assets, exchange in small denominations. I think those would be winners. So all of the usual suspects, basically.
Yeah, we have to wrap up shortly. I might encourage people to second category you mentioned, so partially collateralized stablecoins. I don't think that's been a big enough topic of discussion so far, and could be a really, really interesting direction for the industry to expand. So we'll have to follow up on that one. But Nic, thank you for coming on. Where do people find you? Where can they learn more about Castle Island or hear more of your thoughts?
So yeah, I'm not hard to find. Our fund's website, if you want to look at our portfolio or contact us, is castleisland.vc. That's Victor Charlie. And my Twitter account is Nic, N-I-C, there's no K, Nic, N-I-C __ Carter. So there's 2 underscores. But I write a lot on Medium. I'm writing a post about this exact topic, crypto dollarization, coming out on CoinDesk this week or the next. And we also have a podcast of our own where I'm going to be doing a whole series exploring this concept, which is very interesting to me, and I think going to be the biggest trend in the industry this year.
Amazing. Well, we will have to do a follow-up in a year on how 2020 played out for dollarization.
Yeah.
But in the meantime, thank you again for coming on. This has been really great. I hope everyone learned something. We'll put a bunch of links and thoughts in the show notes. And if anyone has any questions, you can find us out there on Twitter or elsewhere. But thank you again, Nic. Thank you everyone for listening, and look forward to seeing you again soon on CoinList Chats.
Thanks for having me.
Yeah, sure thing. Talk soon. Bye.